Understanding ROE, return on equity, in fundamental analysis. How efficiently is a company using your money to generate profit? What is ROE? Return on equity, ROE, measures how well a company uses its shareholders' equity, i.e., investors' money, to generate profits. It tells you what percentage return the company is earning on the money invested by its shareholders. ROE Formula. ROE equals net income slash shareholders' equity times 100. Net income equals profit after taxes. Shareholders' equity equals total assets, total liabilities. Example. Suppose net income equals 200 Indian rupees crore. Shareholders' equity equals 1,000 Indian rupees crore. ROE equals 200/1000 times 100 equals 20%. This means the company generates 20 Indian rupees profit for every 100 Indian rupees of shareholder capital, a strong return. Why is ROE important? ROE reflects the efficiency and profitability of a company. A consistently high ROE indicates that the company is financially healthy. It is well managed. It has competitive advantages like strong brand, pricing power, etc. For investors, a rising or consistently high ROE signals strong wealth creation. ROE benchmarks. ROE range meaning less than 10% low efficiency / room for improvement. 10% to 20% healthy and acceptable. Greater than 20% strong profitability / efficient use. Note, compare ROE within the same industry. Banks naturally have higher ROEs than utilities, for example. ROE in action. Example comparing two companies. Metric company A, company B. Net income 500 crore Indian rupees, 400 crore Indian rupees. Shareholders' equity 2,500 crore Indian rupees, 1,000 crore Indian rupees. ROE 20%, 40%. Company B has a higher ROE, even though it earns less total profit. This means it uses its capital more efficiently. But high ROE isn't always better without context. See next section. Limitations of ROE. ROE can be misleading when debt is high. A company may borrow aggressively, boosting profits without increasing equity, inflating ROE. Negative equity. If equity is very low or negative, ROE becomes meaningless or artificially high. Inconsistent earnings. One-time gains may boost ROE temporarily. DuPont analysis. A deeper dive. Breaks ROE into three components. ROE equals net profit margin times asset turnover times financial leverage. This shows why ROE is high. Is it due to high margins, better asset use, or just more debt? Using ROE in stock analysis. What to look for. ROE above 15% is typically a sign of a high-quality business. Consistent or growing ROE over 5 to 10 years is ideal. Compare with industry peers and companies' historical performance. How to use it. Combine with other metrics like ROCE for capital efficiency, debt to equity to check for leverage, EPS growth for profitability. Where to find ROE. Company annual reports. Websites, Screener.ai and Money Control, Ticker Tape, Yahoo Finance. Examples of high ROE companies in India, as of recent data, *. Company industry ROE, %. Asian Paints FMCG, 26%. HDFC Bank Banking, 17%. TCS IT, 35%. Note. ROE figures fluctuate annually. Always use recent financials for accuracy. Final thoughts. ROE is a lens into a company's financial engine. It tells you how well the company is using investor money to generate returns. But don't look at ROE in isolation. The best businesses generate consistent ROE with low debt and growing earnings. As Warren Buffett says, the ideal business is one that earns very high returns on capital and can keep using large amounts of capital at those high returns. Make ROE a core part of your analysis toolkit.